Thank you, Becky. Let's bring in Paul Jacobson, CFO of General Motors. Paul, thanks for joining us this morning. On a big day, you beat on the top and the bottom line. You raised your guidance for the fourth quarter. Even though you made less money in the quarter than the quarter last year due to the impact of tariffs, you've raised your guidance. You know there's going to be more than a few investors who look at this and they say, given what's happening with tariffs, how are you able to do what you've done?
Yeah, well, good morning, Phil, and thanks for having us. It's a great, beautiful morning here at the New York Stock Exchange, and we're grateful for them hosting us today. You know, what I would say is, this is really the resiliency model that we've created, and we talk about it a lot in terms of improving inventory discipline, improving our balance sheet, and really focusing on margins and cash flows. And when you look at the adjustments that we've had to work through this year with tariffs, and we've seen some warranty pressure, et cetera, the team's done a really good job of staying focused on our beautiful vehicles. Customers love them, and when you see the range of customers that we can serve with our portfolio, it's been a really strong year. And that momentum has held up, even in the face of a lot of changes around us in the macro.
But just to be clear, you're still seeing an impact from tariffs, what, $3.5 to $4.5 billion for the full year? That's down from previous expectations. How much will some of the offsets that were just announced by the Trump administration help you to further limit the costs of tariffs?
Well, for sure, the announcements that the administration made on Friday are incredibly helpful, and what they allow us to do is to make sure that U.S. manufacturing remains competitive going forward. So the MSRP offset that they had previously announced, they've now kept it at 3.75. It won't scale down in future years, but also expanded the range of parts that are being imported that we can apply that to. So that gives us a little bit of easing on the tariff burden for the year. But overall, we've said, we're going to go out and we're going to figure out how to overcome this and over the longer term work our way back to our 8 to 10% margin range in North America.
Paul, you took a special item impairment charge, basically $1.6 billion for your EV business. Did you make money on EVs? Were you profitable making money on EVs in the third quarter?
Now, as we said, Phil, we had about 40% of our vehicles were variable profit positive, meaning they were contribution positive, but they weren't running EBIT profitability. And we started the year saying that we could scale our way into profitability. Obviously, demand is going to be quite a bit lower with the 7500 going away and really adjusting to that. So what we've had to do is go in and say all the capacity that we built for a regulatory environment that was pointing us to get to 40 to 50% EV penetration by 2030, that's likely not going to be there. So by going in and really reevaluating our footprint and our total capacity for what demand is going to naturally grow to over the next several years, we've had to pull that back a little bit, and that's the reason for the restructuring charge. What that will do is allow the vehicles to be able to improve in their profitability, and we think it gives us a longer runway to be able to get there.
So you have variable profitability in about 40% of those EVs. Do you expect to scale to full profitability, which is what your previous expectation was? And when will that happen?
Yeah. I think that's going to take some time, as we've said. What the slower EV demand is going to do is probably give us a little bit of time with lower volumes to be able to go in and implement some of the architectural and structural cost savings that we've got. We've got new battery technology coming in. We've got new battery form factors, which are going to lower the cost of these vehicles to us by thousands of dollars. And that's going to give us that platform as we see EV volume grow, because we continue to believe that that is a strong future for electric vehicles, and we've got a great portfolio to be competitive. But we do have some structural changes that we need to do to make sure that we lower the cost of producing those vehicles and make them available to a wider variety of consumers.
And so just to be clear here, that's further out in terms of full profitability, or you're not putting a timeline at this point?
That's correct. As what we saw this year, we had originally talked about improving our profitability by $2 to $4 billion this year on electric vehicles. That was going to be subject to some pretty significant EV penetration and share growth going forward. But as we see demand is going to come down with the cessation of the $7,500, we've got to streamline that capacity. But with time, we think that's going to be something that we can still achieve and still be competitive in the EV space.
Let's pivot to the traditional business in terms of internal combustion engine vehicle production. You are expanding that production wherever possible here in North America, adding vehicles that you can produce here in the U.S. How quickly will you be able to ramp that production and take advantage of what is a very favorable market in terms of cheap gas that's out there right now?
Yeah, so for sure, our ICE franchise is doing incredibly well. You know, we had another quarter with over 17% market share. It's the highest third quarter in quite some time, and that's really a testament to the vehicle portfolio that we have. We're doing really well in trucks and SUVs, but also on the lower end of the price market, because as we've seen with vehicle prices going up and interest rates being high, we need to be across the affordability curve. And when you look at entry-level vehicles like the Chevy Trax, that's where the portfolio comes into play, and we're doing quite well. So we are expanding some capacity, onshoring some capacity. We announced $4 billion of capital investment over the next couple of years, still while maintaining our capital discipline. But that's going to bring more production into the U.S. and give us a little bit of incremental production to meet that demand.